as well. So welcome. We're glad you're here. Happy to give you a couple of, oh, Kristen, can we advance the slides or are we stuck? Can you all see one slide that says MCF investment update? Perfect. I can see you, Peggy, so I'm watching your head. You're my signal on how things are coming along here. So want to give you a couple of updates about things happening at MCF. First and foremost, we have a couple new team members that we're very excited to welcome. I mentioned Rebecca Connors earlier. She has hit the ground running and very excited to see the work that she's going to be bringing out of our communications department. We also have a new trust and estate officer who is part of our philanthropy team. Oh, we're back to seeing each other. So we must be having a few glitches, which is, we can live with that. Allie Fontenot, who is in Missoula, and she's a new trust and estate officer. Some of you might know Allie from her time at the Watson's Children's Center or a variety of other capacities that she's had in Missoula. We're really thrilled to have her joining our team. This is not a new position. This is refilling a Missoula-based staff person, and Allie has also hit the ground running. So we're really excited to have both of these great folks on staff. Couple of things on the horizon. I don't know, Kristen, if you want to go to the next slide. Perfect. So if any of you have ever been involved in any of our scholarship work, Jenny Stark, who is our first full-time scholarship officer, is retiring. And it's a huge loss for us. She'll be retiring at the end of the year officially, but I think she'll actually be wrapping up her work in early December. So we're in the process of interviewing candidates for that position now. Just to give you a little sense of the scope of work with our scholarships, this year we granted out more than $1 million to scholars across Montana, and that's a huge number for us. That's quite an increase from previous years. So we're excited about getting that position filled. Hopefully the new person will start no later than the first of the year. I already told you this. See, I get ahead of myself. We awarded more than $1 million. And we had a lot of fun traveling around to different communities and actually presenting those awards. Thanks, Kristen. All right. If you have questions after today's session, Casey Tollefson is your go-to person. Casey is our Vice President of Finance and Administration. This is her contact information. We will be sending this presentation, I think, out to you all via email. It'll be on the website. Casey's not with us today because she's participating in Leadership Montana. She's in the flagship course. Yay, Mary Sue. Yes, I see that. And so she's in Missoula. And I got to tell you guys, this weekend is the big Super Bowl in Montana. The Cat Grizz Cat game, the Brawl of the Wild. Casey is a cat. And when Casey's away during the week of Cat Grizz, sometimes her office gets decorated as a Grizz fan. So Casey's feeling all the feels of being in Missoula this week. She says she's in enemy territory. She sent a great message this morning. But in the spirit of all seriousness, Casey's your go-to person for questions about our investment presentation today. So with that, I'd like to welcome you. Thank you for being here. Many of you know that as a matter of good practice, the Montana Community Foundation every 5 years puts out an RFP, and we look for guidance on our investments. And we actually have again reaffirmed our relationship with Cambridge Associates, our outsourced chief investment officer. They're based in Boston. I think our email told you that Omar Sanchez was going to be presenting today. We're faking you out in the interest of the football game. Omar's not going to be presenting today. Today we have Tim Shepard, who's going to be leading the presentation with Cambridge Associates. Tim's based in Boston, and he can introduce the team. And with that, Tim, happy to turn it over to you. We're really pleased to have this partnership with you. So thanks
Great.
and welcome.
Great. Likewise, it's been incredible last few years. I think we've been working on the relationship for something like 4 years. And I've done these webinars a few times. It's great to see all of you. And we're just here to try to be helpful. We consider ourselves to be the investment team for the Montana Community Foundation. We're not, while we may be physically not that close, we're in Boston, we're a phone call away, an email away. And we like to think we have developed a really strong partnership with the Community Foundation, and we want to be a resource today and to give you kind of a roadmap of what we're planning to do. We're going to talk a little bit about the portfolio, about our team, about the firm, then spend a little bit of time on the investment philosophy that really underpins and influences how we've built the foundation. I'm going to talk about markets because I'm sure a lot of you think that's interesting. If anyone reads the Wall Street Journal, Financial Times, CNBC, what have you, a lot going on. There's always a lot going on. So I'll spend a few moments to talk about markets, and then we're going to spend a little bit of time to actually talk about the portfolio and performance. So that's the roadmap. If there are questions, we're happy to answer those. Again, we want to be as helpful as possible to make this a dialogue. So whether it's chat, raise hands, if you want to wait to the end, it's up to you. I'm joined by some colleagues. Alyssa is an associate director on the team, also based in Boston. Then we have two of our very important investment analysts, Christy and Rachel, on the team. We're a fully resourced team. There's a number of us that are there front and center helping to manage the portfolio. So if we could, we've prepared some slides, we've prepared some remarks, and we'll just jump right in to the presentation. So if I could ask, I think Christy is going to be sharing a few slides. If I could just have you go ahead and do that. And so, yeah, this is some of the information we've provided. We'll go ahead to the next page. It's page 1. Again, we've got some prepared remarks here called the portfolio highlights. Again, we're going to talk about a lot of things, including the team, the firm, investment philosophy. But of course, what's important is the portfolio that we're managing. There's a lot of information on the page here. We like to think it's kind of a high-level snapshot. You may have something similar if you have a personal investment account. When you log in, it kind of gives you kind of a snapshot of what's happening. That's what we've created here. This is all through September, so pretty recent data through the third quarter. Top left of the page is the portfolio in terms of asset allocation. It was valued at just over 137 million as of September. We call this a donut chart. Each of the colors corresponds to a different asset class. All of the blue are equities, so things like stocks, invested in U.S. companies, think Apple, Amazon, et cetera. But then some stocks outside of the U.S. in what we've categorized as developed ex-US. Those are countries like Japan, like the United Kingdom, like Sweden, like places like that. And then the smallest slice you'll see is EM, which is emerging markets, South Korea, places in Latin America, things like that. So that's the equity category in blue. You'll see a category in green, that's PI. Admittedly, it's a little hard to read, so I'll try to make it a little bit clearer. PI, that's private investments. Those are illiquid strategies. Think private equity, venture capital, where we've given money to really amazing investment managers who buy companies, invest in startups. I think of a few people in Palo Alto with an idea in a garage, things like that. That is valued at about 18.7 million, about just under 14% of the portfolio. DS, or if you're looking, following me on the table below, that's the same information, but in percentage form, diversifying strategies. These are, as the name would imply, things that are meant to be diversifying. They're diversifying outside of equities or stocks and bonds. So there are lots of different strategies, and they're meant to kind of help us diversify our return stream. And then the lighter shaded colors in orange and yellow, those are TIPS, which are inflation protected assets, Treasury inflation protected assets. Treasuries, those are high quality US Treasury bonds, the highest quality you can get, the safest you can get, just under 13 million. And then cash, which is just above 3 million. Bottom of the page, again, is that same information, but in percentage form. That's the current exposure. You'll see in the middle bar, that's targets. So these are what we're managing the portfolio to. Those are the targets that we want the portfolio to be at for each category. What you'll notice, you'll see the variance to the right of that. We are managing this portfolio to be close to those targets. We are not, and I'll talk about this in more detail when we get to the philosophy section about, again, our investment philosophy. It's not to be jerking or whipping around the portfolio based on the latest fad or based on some market timing call. We really do not think that is the optimal way to manage an investment portfolio of this nature. It's very easy to mistime markets. A very real-time example, yesterday, after several months of actually poor stock market performance, inflation numbers came out. And if you're a reader of the financial journalism and the markets, inflation print came out around 3%, just over 3%, and markets were very, very happy to see that. Stock markets were up meaningfully yesterday, 2-3%. Small caps are up actually something like 6%, and that followed some pessimism in the market. We don't want to miss those. We think it's absolutely crucial to make sure you're invested and you benefit from the long-term trend in markets. So that's why you see us. The next time you come to this, you'll see very similar. We're pretty close to those targets, and that is by design. Right-hand side of the chart is portfolio performance. I'm going to hand it over to Alyssa a little bit later in the presentation. She's going to provide a bit more color, but that top grayish bar, those are the returns of the portfolio. This is net of all fees. So want to make sure that's clear. Net of all fees, starting with the longest time period to the left, that's SI, which is since inception. Since we've been working with the foundation, bit over 7 years, portfolio is up about 6.5%. That's ahead of our benchmark. So that's what one of the things we're trying to beat. The benchmark's trying to 6.3%. And then to give you a reference, we've put global equity, which is in this case, the all country world index. It's a very well-known, well-referenced index of global stocks, all stocks in the world. It's predominantly US. The US is the biggest market, but to give you a reference of what stock markets have done over this time period. Again, this is a less risky portfolio. It's got more diversification. It's meant to smooth out returns. We are not trying to beat the stock market, but we're trying to achieve something somewhat close to that return. But of course, we're taking much less risk to do that. We'll talk about diversification in a bit, but looking at some other returns, 5-year return is 5.6%, 3-year return, 5.5%, both above benchmark. Looking at the actual performance drivers at the bottom right-hand side, again, we'll go into this a bit more detail. This is for the year to date. It's a really short period of time, but U.S. equity and global equity, again, global stocks. Those are two categories that are driving returns for this year. Global is a bit of an interesting category that we utilize. Global is a go anywhere. This is investing in the U.S., investing in Japan, investing in Taiwan, all sorts of places. They are less constricted with where investments are moving. But again, so this is the snapshot. This is kind of that high level picture of the portfolio. Again, I promise we're going to go into a bunch more detail, but I think it's really helpful to start at the high level, think about the portfolio, where we are today and how we're managing it. But I do also think it's important to talk about us a little bit so you understand who's managing the portfolio. Mary said that we went through the RFP process and we reaffirmed the partnership. Absolutely love to see that. It's something we pride ourselves on is partnership. We think it's absolutely crucial to develop really strong partnerships with our clients. And if we jump ahead to page 3, a little bit about Cambridge as a business. So we've been in business since the 1970s. We actually just hit our 50-year anniversary. Actually, I just got a piece of like a vest says 50 years. We're really proud of it because we've been doing this for a long time and we're independent. We are really proud of that. We have one line of business, and that's managing institutional investment portfolios on behalf of endowments, on behalf of foundations, pensions, and private clients. So we do work with lots of different client types, but our DNA is working with not-for-profit institutions like the Montana Community Foundation. That is how we started. That's how our team works. Our team works with almost exclusively US-based not-for-profits, similar in mission, similar in size to the foundation. It's how our firm started in the early 70s, our founders started working with colleges. They helped them set up their endowment offices and things like that. And we've morphed from there to working with a number. We also are global. That's another important piece of Cambridge Associates. While you may have not heard of us, we like to keep behind the scenes. You won't see us advertising or anything like that. We really like to focus on doing an excellent job for our clients. But we're global. A little hard to see. We've created this kind of cool slide where you see in the back, it's actually a globe of or not a globe, it's a map of the US with darker blue dots. That's where we have our offices. So we're based in Boston. That's where our headquarters are, but we have offices throughout the US. We have another office in the Washington, D.C. area. We have an office in Dallas, Texas, and we also have an office in San Francisco. We have an office in New York City. So, good footprint in the US. But outside of the US, we also have a bunch of offices. The UK, we have an office in London, Munich, Germany, Sydney, Australia, Singapore, Beijing, and Hong Kong. So we are truly a global firm. And with that comes some excellent resources behind us. So talking about us in a little bit more detail, next page is the actual investment team, page 4. This is the team that manages the portfolio. Omar Sanchez couldn't be here today, but he is the investment officer, the chief investment officer of the firm. Not of the firm, excuse me, of the team. He's supported by Jill Shaw, who's our director of private investments, Heather Russell, who's our director of diversifying strategies or hedge funds. You see me on the page, director of portfolio strategy. I focus a lot of my time on marketable investments. That's things like stocks and bonds, where Jill is focusing her time on private investments. Heather on the diversifying strategies. Alyssa, who you'll hear from shortly, she's another very important part of the team. We're also resourced by a number of investment associates and investment analysts. We have 2 on the screen here today. Outside of that, we also have a large and meaningful back office and middle office function that's headed on our team by Dan Sangster. They're doing things like trading and compliance to make sure that's all done properly. And then outside of the team, at the bottom part of the page, shows a bit more about our research platform. It's actually one of my favorite things about working at Cambridge. We have a very tight-knit team. You see it on the page, but we have over 100 research colleagues that all they're doing is working out of our investment offices and looking for the absolute best investment ideas with which we can source from to put into the portfolio. So again, best of both worlds, we like to think of it. Tight-knit, small, accountable team, but yet, really meaningful resources. And to give you an idea, I only work with a handful of clients. I don't have hundreds of clients or anything like that. I have something more like 10. So clients are very, very important to me, and we're accountable and on. And like I said, we get to, have the benefits of using this really big research engine. And, I get to call a colleague in Singapore to talk to him about what's going on in markets over there and investment ideas that they might be finding. So again, best of both worlds. There's some other kind of stats on the page. It talks about legal and compliance, investment operations, things like that. It's a well-resourced team and firm. I don't know what the number is. We have something like 1,300 employees globally, to give you a sense of how many people are at the firm. So moving on, I'm just going to keep chugging away at our prepared remarks. Don't hesitate to jump in with questions. Again, totally fine if you want to wait to the end to jump in, but I'm going to keep talking. But at this point, I'm going to pivot to investment philosophy, which is the next page, which I said from the outset, very important. Very important. And I think, if anything, if you have joined these before, you will join them in the future, you won't see this change. We like to keep a very focused, long-term. I've heard a client call it boring before. I don't think it's boring, but maybe it's boring because it doesn't change much. We have a long-term orientation. We work with mainly, like I said, not-for-profits. Most of these are perpetual institutions. We work with some institutions that have been around 100 years, and they're going to be around another 100 and 100 more after that. And so that means long-term focus is very important, and it really guides a lot of what we do. So again, taking a look here, like I said, long-term is hugely important. And if you think about markets, that power of compounding, that power of growth, $1 turns into $2, it turns into 4, that turns into 8, et cetera, et cetera. It's really an incredibly powerful tool, especially when you have that long-term orientation where that you can have assets stay invested and compound. It's hugely important to growth. And I said this again from the outset, but I think it bears repeating. We don't think market timing is the best way to invest at all. It's not repeatable. It's a great way to miss out on market rallies. I used yesterday as a very kind of quick and obvious example, but there's lots of other examples. So we think it lends itself to making mistakes, to behavioral biases, to missing out on market rallies, locking in losses, cutting risk at the wrong time. So again, you can call us boring. That's totally fine. We have a kind of true tested, long-term steady orientation. So from that, we are still highly risk aware. Just because we have a long-term orientation and we don't do lots of things, to move around risk in the portfolio, we are really obsessed with monitoring it. We're always looking at it. We're tracking the portfolio constantly. We are the outsourced chief investment office of the foundation. So we are always looking at the portfolio. It's not something that we kind of manage and then don't think about. We're always looking at it. We're always on. We're always focused on it. And from that, we make sure that the portfolio is tracking how we want it to be. Think about things like appropriate levels of risk, appropriate levels of liquidity, and we will make incremental changes. If the risk or the asset allocation moves away from where we want it, away from targets, we will make changes to bring it back to where we think it is in line. And again, thinking about things like liquidity, to fund any sort of spending needs or anything like that, that's another thing we're very much keeping an eye on. For the foundation, we've built a customized portfolio. We don't have any sort of cookie cutter thing that happens. We start by getting to know clients really, really well, and then building a portfolio that meets their needs. For the foundation, we have done that. We've built a customized portfolio. There is a growth orientation. So you saw some of the asset allocation at the beginning. We have an emphasis on equity, both public equity, think global stocks, as well as private investments, things like private equity and venture capital. So we definitely have that growth orientation, and that's really so the portfolio can grow over time and increase its purchasing power above inflation. And that's so spending can occur from the portfolio and be more impactful in the future. We don't want spending to be more than the growth of the portfolio. Obviously, inflation is on a lot of people's mind, rightfully so. It's been high, but this growth orientation over the long term has proven to beat inflation. We actually think it's the best way to beat inflation, especially with that long-term orientation. In terms of how we invest the portfolio, we do have an emphasis on active management. When I say that, think of investment managers who are making active stock picking decisions or active bond or private equity decisions. However, we only do so where we have a high degree of confidence in a manager's ability to add value above all fees. And I think that's really key. It has to be above all fees because that's an important thing. You got to beat that. And our active managers use an array of tools at their disposal. Think about fundamental analysis, ripping apart balance sheets, understanding the growth prospects. And they sometimes engage with companies. They might think about the governance or social impact of those companies. They have a lot of tools at their toolkit that are using. And like us, the managers we tend to partner with also take a steadier long-term approach. We don't want the managers that we're investing with to change their stripes drastically, because that's not why we've invested with them. That's not the due diligence that we've performed. We like to also have a steady-based approach. Outside of active management, I think it's important to say we are happy to index, and we do use passive strategies. It's a great way to bring down fees, increase liquidity, increase rebalancing, flexibility as we move money around. So passive is part of the strategy that we've employed. But another thing I would highlight in terms of active management is that emphasis on private investments. I've said it a few times, but bears repeating: private equity buyouts, venture capital. And one of the reasons is we believe we've got a real edge in the space. Cambridge Associates was a pioneer. We have tons of data. We've got that global footprint, and we think we're really good at it. And it can be a growth driver for the foundation portfolio. We have some data later in the presentation that shows that so far, private investments have done very well for the foundation and actually have driven returns. So that's a lot. But maybe one other piece, private investments, because you're locking up capital, it's illiquid. It's very important that you're paid for that. Why would you do that if you're going to have a very similar return to what you can get if you invested in just the stock market? So we expect to beat public markets. It's very important, and we expect to do that in the future. So speaking about the different asset classes that I just mentioned, let's jump ahead to the next page, and it's a page that I call the portfolio building blocks. So here, left-hand side of the chart are high-level categories, and then there's example strategies in the middle, and then the role that they serve in the portfolio. I've said some of this, so apologize if you've taken it in, but again, I think it's important that we all understand what we're trying to achieve. So public equity, those are stocks. Think of buying Apple stock, buying Amazon stock, buying Taiwan Semiconductor, those sort of things. And they come in different strategies. Global equity, that's a go anywhere sort of strategy across the globe, as it kind of, as you would guess. U.S. equity, that's investing in U.S. stocks and then developed X, emerging markets, etc. Role is to enhance return. These are return drivers. So equities are risky, and so we expect those to grow and be a growth engine. Private investments, which I've mentioned, they're actually even more of an enhanced return driver. So really the growth engine of the portfolio. Diversifying strategies, that purple bar. These are exposures you can't get in public markets. They can be doing things like distressed investing, buying assets that are really depressed in price, maybe around a bankrupt company where you can buy things for 20 cents on the dollar, things like that you can't get in other parts of the portfolio. And they're meant to give us a differentiated source of return. Again, as the name implies, a diversifier. TIPS, that's a fixed income security, U.S. Treasury inflation protected security. Spending source, defensive asset, helps to hedge against inflation. And then bonds. In our case, we're only investing in really high quality treasury bonds. The simple reason is we don't think this is the part of the portfolio to take risk. This is the part of the portfolio to be a protective defensive asset, help with spending, help protect against inflation shocks too. There's been a lot of talk about recessions and past recessions. You've been really happy to have these defensive assets because they tend to perform well in recessionary environments. And we also have some cash too, which aids flexibility. These defensive assets are highly, highly liquid, and it helps the defensive nature, especially in times of stress. Continuing on to page 8. This is a fun one I really like to talk about. We call it our quilt chart. We actually talked about it earlier today in the investment community meeting. We bring it up from time to time just to orient you here, because there's a lot of colors, there's a lot going on. It is a busy page. Each column is a year starting in 2002 all the way to the year to date 2003, and each box is a different asset class: U.S. Equity, fixed income, real estate, et cetera, and they're ranked from worst to best in each year. And what you'll probably notice is that the colors jump around all of the time. It's almost like a patchwork quilt. And the simple reason is that there's no asset class that wins in all markets. I wish that was the case where you could just, buy one asset and have no risk, no volatility, and great return. That's not the case. A perfect example is venture capital. Again, if anyone reads the Wall Street Journal or anything like that, it's written about a lot. Venture capital has been a phenomenally high returning asset class over the last several years. It's been a really great place to invest. However, while you would have felt like a genius in 2020 and 2021, if that's all you invested your money, you wouldn't have felt so good in 2022. It was the second worst performing asset class. It went from the highest performing asset to one of the worst. And I also think, if you look at the bottom left-hand side of the page, while it seems like a long time ago, and it was, recall the dot-com crash. Venture capital had eye-popping returns in the 90s, absolute best place to invest. 2000, 2001, 2002, 2003 was a really difficult return environment for venture capital. So we don't want to have that happen. We don't want to have a feast or famine type of portfolio. We've built a resilient, all-weather, steady, diversified investment portfolio because we think that's the best way to invest, especially for institutions that have to spend. And this is the best way to do it. It's a hugely important tool at any investor's in any investor's toolkit is diversification. It's something we've leaned on again, it's one of the most important tools. And we think this quilt chart, which again is busy, admittedly, kind of helps illustrate it again, because the colors are jumping around quite a bit. So another important concept I've touched upon, which is shown on the next page, is staying invested. You may sometimes flip on CNBC and talk about people, moving around their portfolios like crazy. We don't believe in that, because market timing often means missing the best days of the stock market. Again, I used yesterday as an example. You don't want to miss those days. It's hugely important. So here is the S&P 500 return. Just focus on the top of the page. Since 1980, so a long period of time, about 43 years. The S&P 500 has done phenomenally well. Around 11% annualized return over this time period. That's a really excellent return. However, that return, or a huge component of that return, are only a few days. Days where the stock market is up 9%. Up 10% even. You have to be invested in those days to have that excellent long-term return. I think the most important one is if you look at the less 20 best days, that's that green bar. That's only 20 days in a 43-year time period. Not that many, right? But if you miss just those 20 best days, your return would come down from 11.5% to 8.1%. And guess when a lot of those 20 best days happened? They happened right after the global financial crisis in 2009. They happened right after the dot-com crisis. They happened right after, right around when I was born, I think it was a Black Monday or Black Friday in 1987. Happened right after those. You have to catch those days to have that really excellent return. So we think it's hugely important to stay invested, to not time markets, because if you miss those days, you really impair the excellent long-term returns of equity markets. So again, that's just some really important pieces of our philosophy. Just to recap: diversification, a consistent approach, an equity orientation, but also not timing the market, staying invested and keeping that steady, not boring. Remember, it's not boring, it's steady approach. So that is our investment philosophy, and that really influences how we've not only built the Montana Community Foundation portfolio, but how we continue to manage it. So again, I really hope if you join another one of these, you'll see that we are consistent. And if we're not, you should call us out on it, because that's something we pride ourselves on, is a consistent approach that has worked over time. So that's us, that's the firm, that's the philosophy. I'm next going to go into markets, which hopefully I haven't been boring you too much. Maybe that'll be a little bit more interesting, because that's kind of real time what's happening. And then I'm going to hand it over to my colleague Alyssa, who's going to talk a bit about performance. And if that sounds like a good idea and there's no questions, I'm just going to continue to plug away. And I don't see any hands or comments, so I'm going to continue to drone on. So here we've got equity, and this is just market performance. This is through October. Our portfolio data is through September, but this is all through October. It's been an eventful capital markets regime. I feel like I say that all the time. There's always something going on. I don't think the financial journalists ever let us think it's boring, and it's certainly not. So I'm going to say a few things about what's going on in markets. Through October, the stock market retreated. It was off of July highs for the year to date. So markets hit their highs in July earlier this year. Global stocks were off 3.4% for the third quarter. They were down a further 3% through October. So it was a tough couple months. It was really September, October, and August that kind of drove down some returns. This brings year-to-date stock returns to 6.7%. That's for the globe. You can see that far on the right. That's that top bar where we say global. That's 6.7%. So again, that's through October. Still a really solid return despite some volatility that's happened. So up 6.7%. On the other side, the other kind of foundational building block of capital markets and portfolios are fixed income or bonds. They've also not had a great year, as interest rates have been going up. Interest rates are, as they go up, bonds go down. they were down about 3% through October. It's a little hard to read. That's the kind of gold or yellow bars on the page. U.S. aggregate. When we say that those are aggregate investment grade bonds in the U.S., predominantly treasuries, but there's some corporate bonds in there, but only the highest rated corporate companies. Think of the companies that you know well, like the Boeings of the world and the Apples. You know, they're really, really high quality, well-known companies. They command a high credit rating. So the least risky there. So down just about 3% through the year. Taking a step back to the first 7 months, you know, there was that banking crisis that we all remember pretty well at the beginning of the year. And despite that, markets looked past the banking crisis. There was some volatility around that as some small regional banks like Silicon Valley Bank went under, but it was a really strong start through the first 7 months of the year. You know, markets were up much higher, you know, double digits. But the narrative that the Federal Reserve has been kind of spouting for quite some time of higher for longer interest rates, that's something you've probably heard. Interest rates are over 5%. It's the first time in many, many years that the Fed funds rates has gotten up that high. It's been zero for a long stretch of time. And that narrative has really started to weigh on markets. The Fed has signaled that interest rates would stay elevated for the foreseeable future. And that's impacted both stocks and bonds. And they traded lower as of the last 3 years. You know, an important concept is that, especially the stock market's very forward looking. It's not necessarily looking at what's today. It's thinking about what are interest rates going to be in the future. And the Fed is saying they're not going to cut them. They're going to stay elevated. And so that's kind of put a lid on some returns. When I'm saying stock market, I'm talking about financial markets, of course, but what about the economy, where we're all living in, you know, in our day-to-day lives? The term usually is called the real economy. That continues to stay resilient. The labor market is very tight. Unemployment is low. It's near, you know, the lows we've seen. It's crept up a little bit, but, you know, still quite low, especially versus history, kind of, you know, near historical lows. Consumer spending remains strong, and both those things have helped prop up the economy. The economy is doing quite well, actually, especially versus forecasts. A lot of economists thought there'd be a recession in the second half of 2023. It hasn't happened. Of course, there are pockets of you know, maybe not great news and not great data, but when I talk about the economy, I mean as a whole, it's doing quite well. And one case in point is third quarter GDP that came in at 4.9% annualized, above expectations and well above recent growth trends. Granted, it's been a weird couple of years with COVID and things like that, but, you know, we're a developed economy. Our GDP tends to be low single digits, and so a 5% GDP growth was quite strong. Again, and that's really kind of pushed any recessionary fears farther out. You know, they're still there, but, you know, immediately the economy is doing pretty well. And that strong economic numbers has been coupled with inflation coming down. I've said it a few times, you know, just yesterday, the CPI was reported. It showed inflation is indeed coming down. Markets rallied on the news. In fact, stocks are up almost 7% in November. You know, and this means that the Federal Reserve, which their goal right now is to bring inflation down, but not to cool the economy too much. You may have heard the term soft landing. All this data is pointing to a higher likelihood of that happening. I don't have a crystal ball. I don't know what's going to happen. But it looks like it's a higher probability. There's still recessionary risks. There's still risks of speed bumps in the market. But for now, it looks like the Fed's goal of a soft landing is a higher likelihood of occurring. Taking a look at the stock market in a bit more detail, it's been a pretty narrow market. Small group of companies have been doing really, really well. The NVIDIAs of the world, the Apples of the world, et cetera. There's been excitement around artificial intelligence. These companies have been dominating returns, and they've really propped up markets. And if you don't have exposure to those stocks, or if you're underweight or kind of looking at the smaller companies, you would have underperformed. Those have been the absolute best places to invest. Looking at global developed markets have done really well. The US continues to be one of the best performing stock markets. Japan's also done pretty well, but developed markets have meaningfully outpaced emerging markets. One of the laggards in EM has been China. They have a lot of geopolitical tensions going on. They've got stress in the real estate market, things like that, and they haven't done quite as well. I said fixed income yields have been on the rise. As yields go up, that means bond prices are going down. There's been a few things there. Fitch downgraded U.S. debt and kind of put a bit of a negative outlook. There is a deficit in the U.S., and so we're issuing more treasury bonds, more than we thought. And there's this narrative again that the Federal Reserve is going to keep interest rates higher for longer, which has kind of put some dampening of return expectations on bonds. However, silver lining is that bonds today actually have some of the highest returns they've had in a very, very long time. So it's like the 2007 timeframe. They're paying out something around 5% and higher depending on the risk spectrum. So at least the prospective returns for bonds are better than they have been in many, many, many years. So maybe collectively important to say that despite the economy chugging along well today, despite financial markets doing well today, there absolutely are recessionary risks. Like I said, the Fed is trying to bring inflation down, keeping interest rates elevated to do that. But there are risks that they overdo it, and the economy overcorrects. But importantly, in the context of this portfolio, we are well diversified. We have a lot of liquidity, and it's built to handle multiple market scenarios. So we think we've achieved that, and I think some of the results speak for themselves. Because again, it's been a very volatile last few years, and the portfolio has done pretty well. Again, I've said a ton. I'm going to hand it off to Alyssa now. She's going to talk a bit about performance in the portfolio in a little bit more detail to provide a little bit more color, and we'll pause there. Happy to answer questions or anything. And again, appreciate everyone's time, and hopefully this has been helpful.
Thank you, Tim. If we can jump ahead to page 13. Here, the data on this page is as of the end of September. The top half of the page, we have an exhibit illustrating portfolio growth in dollars. The bar on the left shows the starting portfolio value for when we began our relationship with Montana. And the bar on the right shows how the portfolio now has more than doubled to get to that 137 market value that we have today. So that's been very positive to see in a period of what now has been 7 years and 2 months. The growth that we've had has come from two important sources. One has been from solid investment performance that has added $42 million to the portfolio. There have also been net inflows of $32 million. So more has been coming into the portfolio than what has been coming out. So that has also been additive, and we've been able to invest those dollars and put them in work. On the bottom half of the page, we have our annual portfolio performance. Looking at year to date, as Tim mentioned, the first half of the year, we saw equity markets do extremely well. We saw a rebound in growth assets. Names like Amazon, Nvidia, and Apple in the US stock market rallied. And a lot of that rally was driven by generative artificial intelligence and its potential to drive innovation. So the Montana portfolio picked up a lot of that upside in that market rally, and it's just sitting shy of 6% year to date. Just make a few comments on some of the historical years. 2022 was a challenging year, largely a function of the market environment. We witnessed a market correction in both equities and bonds. It was a time where there was really no place to hide, as both of those asset classes were down. So while we're never pleased to see a negative number on the page, a positive takeaway would be that the portfolio protected against the volatility that we witnessed. Equity markets were down over 18%. And that's largely due to the diversified portfolio that we've built, and that has held up well in comparison, and also against the policy benchmark. To finally add, this comes after 4 years of very strong double-digit positive performance. We'll say in 2017, the portfolio was up 17.5%. Then we had 3 consecutive years. In 2019, the portfolio was up a little over 19%. 2020 was up 15.7%, and 2021 was up 15.9%. And that brings us all together with a very strong annualized return of 6.8%, ahead of our benchmark for this period. The next slide, it shows our since inception performance by asset class. There are a lot of colorful bars on this page, so to just quickly orient you all, the blue bars on the left-hand side represent our equities. The purple bar in the middle represents our diversified strategies. The orange bar is our tips, and our yellow bar is our treasuries. So just looking at the blue bars on the left-hand side, the first bar represents our total public equity, and that is a roll-up of a few different geographies, and that breakup of those geographies can be found to the right. So that includes our global equities, US equities, developed ex-US equities, and emerging market equities. At a total level, this part of the portfolio continues to be a growth driver, up 8.3%. Looking at the sub-geographies on an absolute basis, US equities have continued to lead the way in terms of geographies, as it has for quite some time, up 11%. To the right of those two bars, we've had some nice value added from our developed ex-US equity and emerging market managers who are outperforming their benchmarks. Those asset classes are up over 6% and almost 5%. The purple bar in the middle are hedge funds. Those are close to in line with their benchmark. Though in the near term, we've seen this allocation being a leading contributor in the volatile environment we've been in, as there's been many opportunities for our managers to take advantage of. Orange are our tips. Those are our treasury inflation protected securities, which are slightly up since inception, and yellow is our treasuries, the only asset class to be slightly down on the page. And that's largely affected by 2022's tough year when we had rising rates. Last but not least, private investment performance. We have noted their returns in the text box on the center of the page. You'll see since inception, they're up over 22%, being a top driver in both absolute and relative terms. Clearly, the decision to pursue more illiquid investments has paid off as it's added significant value to the portfolio. All in all, the contribution of these asset classes have contributed to the strong total assets return, which is close to 7%. I will pause here if there are any questions, but then can also pass it back to Tim to make some closing remarks.
That's the kind of the bulk of the presentation we had prepared to share, but I realized I maybe talked for a little bit too long because we're not that far from the top of the hour, so apologies. I do want to make sure there's time for any questions, so maybe a good time for us to stop and handle any comments or questions. Happy to be helpful.
On the website of Montana Community Foundation, it says our assets were 150 million. So looking at the future, how soon till you think the market will get back there?
Peggy, if I can just, the Cambridge report is our pooled investment portfolio of our endowment. And we do have other assets besides the endowment that makes up some of that difference. And we also have some assets that are endowed that are managed elsewhere. And so Tim's report and the team's report today is on our pooled portfolio at Cambridge. I should have said that at the beginning. And a couple other points that I always like to remind you all of is the assets that we pool for investment are for the benefit of your communities and your charitable organizations. And we have a legal and fiduciary responsibility to make sure that we're investing those assets for the long term. As Tim pointed out when he was speaking, we're not timing the market. We're not making sure that we're keeping up with what's hot today. We're really inflation proofing that the endowed funds so they can benefit and stay strong for your communities and your charities well beyond the look back of 1 year or 5 years or what have you. And we just had an investment, I mentioned earlier, some of you might have not heard me say this, we had an investment committee meeting this morning, and one of the things that Cambridge does annually, hi Tom, nice to see you, that Cambridge does annually is they stress test our portfolio, and they present to the committee, how would our currently constructed portfolio have performed looking at some of the real financial crises that we've had, and what does liquidity look like? And I'm I'm happy to share with you all that we're in very strong financial shape, looking at all of that stress testing and the recovery. So Cambridge does a remarkable job with that, and we're very pleased with the relationship.
Thank you.
Yeah. Any other questions? Greg.
One question I have is what efforts are being made from existing organizations that have funds within our Montana Community Foundation? Is there much effort being done to try to get those organizations to expand their endowments within our community foundation? I know, of course, I was one of the foundation board members early on when we were, trying to. Our big target was to have $5 million. Well, of course, you far exceeded that, but I mean, we had a lot of organizations that started endowment funds with the Montana Community Foundation in those days with as little as $500. And so, but are we going back and talking to those same organizations and kind of encouraging them to revisit their investment or to expand on that?
I can answer that with a couple things that we're doing, Greg. So we've committed, we actually have staff on board, our philanthropy officers, that help the local charitable organizations with their endowment growth. We also have a local community foundation program officer that works specifically with our program, with our local community foundation affiliates, to grow those endowments. In fact, just this year, our board approved an LCF, Local Community Foundation Plus incentive program, where we will be incentivizing and matching endowment contributions to local community foundation endowments. And one of the things, in fact, just the deadline for applying is today. So we should know kind of by the end of the day today, how many local community foundations are in. We've committed $1 million in matching funds to help those community foundations maybe leverage growing those endowments. And there are a lot of other charitable organizations that are not necessarily community foundations, some of which are very focused on endowment growth. Some of them, that's kind of the next tier of their organization's financial stability plan. And we're working with several of those over time. In a perfect world, maybe 5 years from now, I don't know when the time frame will be, I would love it if we could actually put together an incentive match for all of our charities, not just our local community foundations, but we're starting there because we have those really close relationships with those folks. So those are a couple things that we're doing. I'd also say in the next year, keep your eyes peeled for some other things that we're going to be doing to make people aware of what's happening in our state relative to this. We've updated the intergenerational transfer of wealth study. We have new numbers to share there, and then some other programming things that we'll be doing to help hopefully spark some enthusiasm and excitement around endowment building. Because as Tim and the team noted, our endowment has more than doubled. And a big chunk of that is because of endowment investment returns. But another big chunk of that is new inflows into the endowments. And we're really proud of that. And so that net number we don't even show you the 4.5% that we pay out every year as well. So those are a couple of the things that we're doing to encourage endowment growth and encourage those charitable organizations, reminding them that endowments are the things that are sustainable. And actually several of the folks on this call, I'm looking around at the names, the Helena Area Community Foundation, Sealy Lake, Peggy's group up in Northeast. I mean, just looking at all these organizations that are laser focused on endowment growth. So it kind of is as much as the organization themselves is focused on endowment growth, but we're here to help for sure. That was a long answer. You're always going to get a long answer from me.
Apparently me too.
Other questions?
It was a long, am I on? It was a
Yeah.
long answer, but I, I think of, here in Great Falls, I mean, I've lived here a long time, and I haven't heard much of anything about the Great Falls Community Foundation, because we have some other very active foundations like the public the school foundation, but there's a lot that I think could be done here, but I don't even know who's on our the local Great Falls area community foundation. We used to be called the C.M. Russell region, but I guess those have all been renamed by now.
Well, we can follow up, Greg, and connect you with that person. Happy to do that. Thumbs up, that technology always works. Okay. Oh, I see we're over time. So any other questions, or feel free to reach out to us with an email if you do have other questions. It's delightful to see so many of you.
We will get the recording posted on our YouTube and our website this afternoon. And you will see it in the Infinity going out tomorrow, the Infinity newsletter, and we will put it out on social. So you can find it in the next few days.
Great. In the meantime, stay cool, because everybody's apparently very warm these days. Nobody has snow or cold weather. So Greg will follow up and get you that connection. It's great to see so many of you. Have a fabulous day. And thank you, Tim and team.
Everybody.